Hello, I'm Bernard Hickey from interest.co.nz and welcome to another in our series of double shot interviews where we bring in a CEO or a minister, or in this case David Cunliffe, the opposition finance spokesperson, and from the Labour Party obviously. He's fresh from the Labour Party conference where one of the main features was an announcement about the foreign ownership of New Zealand assets. David, what was the thinking behind Labour's move? A bit of a turnaround on foreign ownership of assets.
Yeah, I think there's a lot of new stuff coming through from Labour, Bernard, which will be of great interest to interest.co viewers. And foreign investment, the position that we've taken, is certainly a break from the past, which was a very open prescription. Anybody who wanted to come to New Zealand and buy up assets could basically do so, as long as they weren't a wanted criminal from Interpol. It was about the only time it ever got stopped, or if it happened to be a wahi tapu on a beach. The current change really reverses the presumption on farmland sales above 5 hectares and on monopoly infrastructure above a 25% safe harbour, and there's some other balancing provisions which I'll talk about. On land sales, the argument is pretty simple, and I know that you've used it consistently recently on interest.co yourself, and that is in a post-global financial crisis world with huge currency imbalances and trade imbalances, there will be some countries, particularly emerging economies, who will be able to afford to unbutton New Zealand's underlying asset endowment of land that feeds through to our core competences in agriculture and dairy, etc., and acquire the value streams from those resources and potentially to do a lot of the further processing under their own ownership or even in their own country. And New Zealand over time, if that process is left unchecked, will be even more than it is now, a low-value resource extractive economy. Now, Labour's policy doesn't make it impossible for people to invest in New Zealand, but it does put the burden of proof on the investor to show that that investment will bring with it added value to New Zealand, such as processing, distribution chains, technology, and won't simply be an acquisition of our underlying resources. To do otherwise, I think, would be irresponsible in the current global environment.
So it focuses on farmland, but it also talks about monopoly assets. What are you talking about there?
Yes, it does. There's a relatively short list of monopoly assets which we consider as a starting proposition, and we're open for discussion, are both strategic in that they would be potential choke points on our economy, and they are clear monopolies for whom no alternative exists. And that's another and different rationale, but an equally important one. You don't want to sell out control to the jugular veins of your economy, otherwise you will find that others are either able to extract monopoly rents or make decisions which potentially might not be in the national interest. And for that reason, it's appropriate to, again, reverse the presumption whereby there's a safe harbour up to 25% ownership. Above that, it would require a ministerial discretion, and a sensible minister would want to have some public rationale for why that discretion was given.
Why exclude telecommunications and the power generation assets from that monopoly list?
Well, there are separate reasons for both, and consideration was given to both of those asset classes. Telecommunications, you might potentially charitably add, following the reforms of the last decade, is now a much more competitive market than it was. There is no single provider that really dominates the whole market, and depending how the government calls its ultra-fast broadband rollout, we would anticipate the market to trend towards higher levels of competition. Government could get that wrong, of course, but we're being charitable. And we also know that there is a particular need for more capital to flow into telecommunications infrastructure, and for that reason at this time we did not think it was appropriate to add it into that list, acknowledging also that the list is not retrospective, and there's already a very high level of foreign ownership in our underlying telecommunications infrastructure.
Now, playing devil's advocate, can New Zealand afford to put up this barrier to foreign investment, given we're still running pretty hefty current account deficits?
Firstly, we recognise the issue that the world is relatively capital scarce. We're not living in a world where people are running around trying to force eurodashis down our throat, and that therefore we do have to have a prudent approach. And that's why the other half of this policy is to actually be more active in working with the private sector to go and seek the greenfields investment that we know that we need. But that'll be investment that actually builds stuff, does stuff and exports stuff, not just unbutton stuff that's already here and transfer the value stream somewhere else. And so you can expect a Labour-led government to be quite active in working with business and in wooing private investors who've got a real contribution to make in New Zealand. New Zealand remains open for business.
But the elephant in the room here is if we take away foreign buyers, will land prices drop?
Yes, they will to some extent, and they should to some extent. Hopefully that process will be managed and it will be gradual. But the days of farming for capital gain rather than the downstream value of the products are produced are and must be over.
Now, some other countries around the world are dealing with these so-called currency wars by putting taxes on foreign investors in local debt, so government bonds and corporate bonds. Should a Labour government look at these sorts of taxes on foreign investment in local debt?
Labour has indicated in its new monetary policy framework that we would investigate the possibility of a tax wedge on aggregate inbound financial flows as a potential monetary policy complement to the OCR. We haven't yet explored a more generalised use of bond-based loan taxes, if you like. That's something that we could potentially have a look at. But it's not Labour policy at this point.
Now, looking at monetary policy, that's another aspect of your perhaps change in approach.
Definite change in approach.
You've opened up, had a review of monetary policy.
Yep.
What's your thinking at the moment on how it should be run?
So what's really interesting about monetary policy, Bernard, is a year ago when Phil Goff, on behalf of our team, said the old monetary policy consensus, like the Washington consensus, is over. Everybody went, horrors! You know, it was like farting in church or something. It was, it was seen as not something that should be done. Well, what's really fascinating is now pretty much everybody in the world has made clear that they've moved past the old consensus too, and certainly our Reserve Bank has moved past the old consensus because they've implemented the core assets ratio and the idea that they're going to make it counter-cyclical. Well, I think that's exactly what we were saying, and what's really interesting is that they've done that not only without reference to the Beehive and the Minister of Finance, but the Minister of Finance was defending and has consistently defended the old orthodoxy, not the new one, which the Reserve Bank is busy implementing. So, it's nice to have Alan Bollard on our side, but we do think that there are a lot, in all seriousness, that there are further questions that need to be explored. Why are we doing this? Quite simply because our exporters are being killed. We've got a Kiwi dollar that's approaching 80 cents US. We've got an Aussie dollar that's reached USD parity, and it's against the background of a global currency war potential, which could see the US dollar fall further, and the New Zealand dollar continue to be a cork in the ocean. And it is just not okay, and it is actually not possible for a small or medium or even a large New Zealand exporter to hedge away that risk. And whether it's a high or a medium or a low average value, business people need to be able to plan within reasonable bounds how they are going to face foreign currency markets.
But how can you do that without having formal currency controls?
Oh, well, there are a number of different models. To use the jargon of the trade, what we are proposing is that New Zealand move away from a free and ultra-pure float to at least something, I would say, a dirty float where the Reserve Bank is intervening more often, more aggressively to put up costs and risks on speculators. I mean, it is not for no reason that the New Zealand dollar is, I think, the 10th most traded currency in the whole world in aggregate, which is bizarre. We're a country of 4 million people. I understand we're the second most highly traded currency per capita. That is bizarre. Why is that? Is it good for us? No. How do we make that less likely to be the case? We impose some costs on those who are clipping the ticket on the transaction. And sporadic, unpredictable and decisive intervention by our central bank is one way that we can do that, to give some of those soft shoe speculators the message that while we are open for productive business, we are not going to be the plaything of currency traders. Thank you very much.
On the issue of wealth taxes, there was a mention in Phil Goff's speech about that. What's Labor's approach on a capital gains tax or a land tax?
Well, as I've said to media, Labor has not completed its review of tax policy. We have a number of options currently underway. Our bearing points are several. One, that we need to make this economy more productive. We have to grow real businesses. We want an active, not a passive, economic development strategy, and we want that to be a partnership with business. And we want real businesses that export things to be in a better position, not a worse position. Now, that might mean that we need to bust away some of the old constraints in order to grow some industries. And we will certainly look at that. On tax, somebody is going to have to provide the means to help us both grow our economy and protect some of the most vulnerable. And at the moment, the government has just seen its estimates of tax revenue fall by $4 billion relative to the previous estimate, and that's going to have to be made up somehow. So the question is who? At the moment, the government's giving tax breaks to the most privileged, and we don't think that that is appropriate. We need to see more equity, and we need to see more productivity with it.
David Cunliffe, thank you very much. That was David Cunliffe, the finance spokesman for Labor, talking about the Labor Party conference and the big change in approach announced in Phil Goff's speech yesterday. I'm Bernard Hickey. That was another in our double shot series of interviews here on interest.co.nz.